Hey everyone, welcome back to We Are Cosmic, your go-to place for crypto insights, finance breakdowns, and understanding how global events affect your money. If you want to know what's really moving markets and how to position yourself before everyone else, you're in the right place. Today, I'm about to take you through what might be the most critical 48 hours in global finance. In years. Seriously, this is not hype. What happens over the next 2 days could affect your portfolio for the next 6 months. Let's start with the big picture. On February 11th, the Bank of Japan, BOJ, is making a decision that could shake the entire world economy. They are deciding whether to keep printing money or raise interest rates. Sounds simple? It's not. One small decision made by a handful of bureaucrats in Tokyo will trigger a chain reaction that could impact everything from your stocks to your crypto holdings. Now, why does Japan matter so much? Japan is not just another country, it is the foundation of global easy money. For the last 40 years, since the 1990s, Japan has been fighting deflation, meaning prices falling, wages stagnant, and no real growth. To stop this, the BOJ has done things no other central bank has done. Zero interest rates, negative rates, printing trillions of yen, buying government bonds, corporate bonds, stocks, and ETFs. In other words, the Bank of Japan became a hedge fund disguised as a central bank. For decades, all of these actions failed to ignite sustainable growth. But then, in the last 18 months, inflation suddenly appeared, not from domestic strength, but from external shocks, like energy costs, global supply chain issues, and a weak yen making imports expensive. Now, Japan is seeing inflation around 3 to 4%, or the highest in 40 years. People who spent their adult lives in a world of stable prices are suddenly panicking because their savings are losing value and their cost of living is rising. Here's the dilemma. If the BOJ continues printing money and keeps rates near zero, inflation will accelerate, the yen will weaken, and imports will become even more expensive. But if they raise rates, they risk crashing the stock market, destabilizing government finances, and reigniting deflation, the very problem they've fought for 30 years. In short, the BOJ is trapped, and the consequences of either choice ripple across the world. This is why you, as an investor, need to pay attention. Japan holds over $1.2 trillion in U.S. treasuries, making it the largest foreign holder of U.S. debt. Any change in Japan's policy can impact U.S. interest rates, stock markets, real estate, and even crypto prices. And if you think this is far away and doesn't affect you, think again. The Satar yen carry trade. Borrowing cheap yen and investing abroad has been a hidden liquidity source for global markets. If it unwinds, it could trigger selling across everything: stocks, crypto, and other risk assets. So here's the first thing you need to do. Stop, pause, and understand what's coming. I'm going to break down exactly what February 11th could mean for your portfolio step by step. But first, make sure you hit that subscribe button and turn on notifications, because this series will be packed with actionable insights you won't find anywhere else. All right, now that we understand why February 11th is so important, let's dig into Japan's economic history and why their central bank's decision matters not just to Japan, but to the entire world. For over 30 years, Japan has been stuck in a deflationary spiral. After the asset bubble burst in 1990, prices fell, wages stayed flat, and economic growth was almost zero. Imagine living in a country where, for decades, you don't see your salary grow and the cost of things stays the same or even drops. This is deflation, the opposite of what most countries try to achieve. To fix this, the Bank of Japan, BOJ, did things almost no other central bank would dare. They set interest rates to zero, then even negative. They printed trillions of yen, bought government bonds, corporate bonds, stocks, and ETFs. In effect, they became the biggest shareholder in the Japanese stock market. The goal? Force inflation, boost spending, and restart growth. And yet, for decades, it didn't work. Inflation stayed stubbornly low. People didn't spend, companies didn't invest aggressively, and Japan's economy slowly trundled along. Then something changed. In the last 18 months, inflation finally appeared, but not from internal growth. It came from external pressures, rising energy costs, global supply chain issues, and a weak yen making imports expensive. Suddenly, Japan saw 3 to 4% inflation, the highest in 40 years. For a population used to stability, this is a shock. Now the BOJ is facing a dilemma. If they keep printing money and holding rates near zero, inflation will continue to rise. Prices go up faster than wages, living costs increase, and the currency weakens. But if they raise rates, they risk collapsing the stock market, destabilizing government finances, and triggering deflation, the very thing they fought for 3 decades. Let's look at the numbers, because this is where it gets serious. Japan's government debt is over 240% of GDP. That's $10 trillion of debt on a $4 trillion economy. The only reason Japan can service this massive debt is because interest rates are so low. A tiny rise in rates has massive consequences. For example, if rates rise just 1%, Japan's interest costs jump by hundreds of billions per year. At 2%, the cost doubles. At 3%, Japan would be paying around $300 billion a year just in interest, more than they spend on defense, education, or healthcare combined. And here's the scary part. If the government prints more money to cover interest, it fuels inflation, which pushes rates higher, which forces more printing. This creates a self-feeding spiral that could spiral out of control quickly. The global impact is huge. Japanese investors, pension funds, insurers, and banks are watching these rate changes closely. If yields rise in Japan, capital starts coming home. This is called repatriation, and it has already begun quietly. Money flows back from U.S. treasuries, U.S. stocks, and other foreign investments into Japan. While this may sound good for Japan, it pushes U.S. interest rates up, raises borrowing costs, and can cause stock and crypto markets to drop. On top of that, Japan powers the yen carry trade, a system where investors borrow cheap yen and invest in higher-yielding assets worldwide. If Japan raises rates and the yen strengthens, this trade collapses. Investors face losses, margin calls hit, and forced selling spreads globally. This is exactly the kind of chain reaction that could send shockwaves through markets everywhere, including crypto. So, the key takeaway for you as an investor is this. The math in Japan is unforgiving. Small rate changes can create massive effects, not just in Japan, but in every market connected to it, including stocks, bonds, crypto, and commodities. Understanding this math helps you see why February 11th is not just another central bank meeting. It's a potential global financial pivot point. Now that we understand Japan's economic trap and the math behind it, let's talk about why this matters to you, especially if you're invested in U.S. stocks, bonds, or crypto. Japan is not just an isolated economy. It is deeply connected to the global financial system. One move from the Bank of Japan, BOJ, can trigger massive ripples worldwide. First, consider the U.S. markets. Japan owns over $1.2 trillion in U.S. treasuries, making it the largest foreign holder of U.S. debt. For decades, Japan has been financing the U.S. deficit by buying government bonds. This helped keep U.S. interest rates lower than they should be, supporting cheap borrowing for businesses and consumers. Now imagine if Japan stops buying or even starts selling these treasuries. Suddenly, U.S. borrowing costs rise, mortgages, corporate debt, and credit card rates increase. This is not a small change. It impacts everything from home loans to business growth. Stocks may drop as a result because higher borrowing costs reduce corporate profits and consumer spending. Next, let's break down the yen carry trade, which is critical for global risk markets, including crypto. The carry trade works like this. Investors borrow yen at almost zero interest, convert it into dollars or other currencies, and invest in higher-yielding assets like U.S. stocks, emerging market bonds, or crypto. For years, this trade has been a hidden liquidity engine for risk assets. Every market dip was often supported by cheap yen money flowing in. Here's the catch. If the BOJ raises rates, the yen strengthens. That borrowed yen now becomes more expensive to repay, especially if you borrowed millions using leverage. Investors face losses, margin calls hit, and forced selling starts. And when many investors unwind positions at once, it creates a cascade effect. U.S. stocks fall, crypto falls, risk assets drop sharply. This is exactly how a localized policy decision in Japan can trigger global financial turbulence. Crypto investors, take note. Leverage is common in crypto markets, and sudden sell-offs can be extreme. If the yen carry trade unwinds and capital floods out of risk assets, even strong cryptos can experience sharp drops. This is why global macro events, not just domestic crypto news, matter for your portfolio. February 11th could mark the beginning of massive volatility in crypto markets. There's another angle. capital flows. If Japan normalizes rates and the yen strengthens, capital may repatriate to Japan, targeting domestic bonds and equities. Japanese equities, for the first time in decades, are becoming attractive because companies are shifting from a stakeholder model to a shareholder-first approach, more dividends, buybacks, and profit focus. As Japanese assets draw in capital, the U.S. markets could see outflows, putting additional pressure on stock prices. So, how do you prepare? Watch the yen closely. It acts as an early warning system. If the yen surges into February 11th, it signals that the market is pricing in a BOJ rate hike and that risk assets may be under pressure. If the yen weakens, the market is leaning toward continued accommodation, which may temporarily boost risk assets. Diversification is key. Don't put all your money in one asset class. Spread across U.S. stocks, bonds, crypto, commodities, and precious metals. Each class reacts differently to a BOJ decision. Reducing leverage is critical because forced liquidations in leveraged positions can wipe out gains quickly. Finally, remember this. February 11th is not just another meeting. It is a turning point for global finance, risk assets, and even crypto. If you position wisely, you can protect your portfolio and even find opportunities. But if you ignore it, the sudden moves could be brutal. In the next part, we'll explore the different scenarios for February 11th. What happens if the BOJ holds rates, raises rates slightly, or aggressively normalizes? We'll also break down how each scenario impacts markets and your investments so you can plan ahead. I'm ready to continue with part 4, where we analyze all possible BOJ decisions and their market consequences. Do you want me to go ahead with part 4? Next, great. Here's part 4, 600 words. Focused on all possible BOJ decisions and their impact on global markets in simple English and paragraph style. Part 4, scenarios for February 11th, what could happen? Now that we've covered Japan's economic situation and its global connections, let's explore what could happen on February 11th and how each outcome affects the markets, crypto, and your investments. The Bank of Japan, BOJ, essentially has 3 main paths, and each one comes with risks and opportunities. Scenario 1, the BOJ holds rates steady. If the BOJ decides to keep rates near zero and continues its bond buying program, this signals that they are still committed to fighting deflation. The immediate impact would be a weaker yen because investors expect continued cheap money in Japan. A weaker yen temporarily benefits the yen carry trade, allowing leveraged investors to keep borrowing yen cheaply and investing abroad. U.S. stocks, emerging market equities, and even crypto might see a short-term boost because liquidity remains abundant. But there's a catch. Inflation in Japan continues to rise. Prices of imports, energy, and daily goods keep going up. This increases pressure on households and businesses. For global markets, this scenario could buy time but also build tension. Investors may enjoy a short-term rally, but the underlying economic problems in Japan don't go away. Eventually, the BOJ will have to act, and the move could be even sharper when it comes. Scenario 2, small rate hike, 0.25%, and gradual normalization. If the BOJ raises rates slightly and signals that normalization is coming, this is a cautious approach. The yen would likely strengthen, and the carry trade could start to unwind. Investors who borrowed yen to invest abroad now face higher repayment costs, forcing some to sell foreign assets, including U.S. stocks and crypto. Markets may experience weeks of choppy and volatile price action. There will be no clear trend. One day gains, the next day sharp losses, as traders try to assess the BOJ's path. Risk assets may decline, and leveraged positions in crypto or stocks could be squeezed. For you, this scenario is a warning signal. It's not the end of the world, but it's a signal to reduce risk, take profits on highly leveraged positions, and diversify across asset classes. Watching the yen closely gives an early indication of the trend. Scenario 3, aggressive normalization, 0.5% plus rate hike. This is the nuclear option. If the BOJ raises rates aggressively, it could trigger a massive unwinding of the yen carry trade. The yen would surge in value, leveraged investors worldwide would face huge losses, margin calls would cascade, and forced liquidations could hit multiple markets simultaneously. In this scenario, U.S. stocks, crypto, and other risk assets could drop sharply in a short time. Volatility would spike, liquidity could vanish, and central banks may even have to step in with emergency measures. Japan's domestic markets could benefit from higher rates and a stronger yen, but global markets may experience a shockwave of selling and repricing. For investors, this is the scenario where preparation matters most. Reducing exposure to highly leveraged assets, holding cash or stable investments, and diversifying into safe havens like gold, silver, and Japanese bonds could protect your portfolio. Key takeaway: each BOJ decision triggers different market reactions. Holding rates keeps the status quo, but builds future pressure. Small hikes create volatility and caution. Aggressive hikes could spark a global financial ripple, affecting everything from stocks and bonds to crypto and real estate. In the next part, we'll focus on practical strategies for positioning yourself, including how to protect your portfolio, benefit from potential moves, and spot early warning signals before the market reacts. I can move on to part 5, which will be all about practical positioning, risk management, and how to prepare for Japan's decision. Do you want me to continue with part 5? Next, perfect. Here's part 5, 600 words, focused on practical strategies, risk management, and preparing for Japan's decision in easy-to-understand English and paragraph style. Part 5, how to position yourself before February 11th. Now that we've analyzed Japan's situation, the possible scenarios, and how global markets could react, it's time to talk about what you should do as an investor. February 11th is not just another meeting. It is a potential turning point that could affect stocks, bonds, crypto, and commodities worldwide. Preparing now can protect your portfolio and even create opportunities. 1. Reduce risk in high leverage positions. If you are heavily invested in U.S. tech stocks, leveraged ETFs, or crypto with borrowed money, February 11th is a warning sign. High leverage positions can amplify losses if markets suddenly drop. Consider taking profits, raising cash, and lowering exposure to positions that could be heavily affected by rate changes or the unwinding of the yen carry trade. Even a small move in Japan could trigger a domino effect. 2. Diversify across assets. One of the most important strategies is diversification. Don't rely on a single asset class. Stocks, bonds, crypto, precious metals, and cash all react differently to global events. If Japan's policy triggers the carry trade unwind, risk assets may fall, but gold and silver often gain as safe havens. Bonds in other regions may benefit from lower interest rates or weakened currencies. Spreading investments reduces the chance that a single shock destroys your portfolio. 3. Watch the yen closely. The yen acts as an early warning system. If the yen starts surging ahead of February 11th, it signals that markets are pricing in a rate hike and that risk assets could come under pressure. If the yen weakens, it suggests continued monetary accommodation, which could temporarily boost global markets. Monitoring the yen gives you a head start before the news officially hits. 4. Consider Japanese assets. If the BOJ normalizes rates and the yen strengthens, Japanese bonds and equities could become attractive investments. Rising bond yields in a strengthening currency can outperform U.S. duration risk. Japanese stocks, benefiting from new shareholder-focused reforms, offer dividends, buybacks, and potentially undervalued opportunities. This is a rare chance to position yourself ahead of a capital repatriation wave. 5. Hold precious metals. Gold and silver are critical hedges in both scenarios. If the BOJ keeps printing, the yen weakens, and inflation accelerates, precious metals protect your wealth. If the BOJ raises rates aggressively, triggering global market volatility and central bank interventions elsewhere, metals again act as a safe haven. Either path makes holding some allocation to gold and silver a smart move. 6. Prepare for volatility. No matter what happens, expect violent market swings. Algorithms, margin calls, and global trading can move trillions in seconds. Don't panic sell during short-term drops. Instead, plan exits and entry points now, set clear risk limits, and consider keeping some cash ready to take advantage of temporary dislocations. 7. Keep an eye on global signals. Beyond the yen, watch Japanese bank reports, JGB yields, and credit spreads. Early signs of pressure in Japan often appear before markets elsewhere react. The sooner you recognize these signals, the more time you have to adjust your positions and protect your investments. In short, your strategy should focus on reducing leverage, diversifying globally, monitoring early warning signals, allocating to safe havens, and considering Japanese opportunities. Preparation is the key. The BOJ decision could trigger anything from short-term volatility to a multi-market repricing. In the next and final part, we'll summarize everything and outline a step-by-step checklist to survive February 11th and the weeks that follow, making sure you know exactly what to watch, what to adjust, and how to position for both risk and opportunity. I'm ready to create part 6, the final segment, with a full summary, actionable checklist, and final advice for your audience. Do you want me to go ahead with part 6? Next, perfect. Here's part 6, 600 words, the final segment with a full summary, actionable checklist, and final advice for your audience in easy to understand English and paragraph style. Part 6, final summary and actionable checklist. All right, everyone. Welcome to the final part of this series. We've covered a lot: Japan's economic history, the BOJ's dilemma, the yen carry trade, global market connections, and strategies to protect your portfolio. Now it's time to tie everything together and give you a clear, actionable plan for February 11th and beyond. Let's start with the big picture. The Bank of Japan has been fighting deflation for over 30 years with zero or negative interest rates, trillions of yen printed, and massive bond and stock purchases. For decades, these measures failed to create lasting growth. But now, inflation has arrived due to external shocks, energy costs, supply chain disruptions, and a weak yen making imports expensive. For Japan, this creates a trap. Keep printing and inflation accelerates. Raise rates and the economy risks collapse. Either way, the decision will impact global markets, U.S. equities, bonds, crypto, and commodities. Next, remember the scenarios we discussed. BOJ holds rates, the yen weakens, the carry trade continues, global risk assets may temporarily rise, but inflation pressure builds in Japan. Small rate hike, 0.25%, yen strengthens, carry trade begins to unwind, volatility increases, risk assets may experience choppy price swings. Aggressive normalization, 0.5% plus, yen surges, carry trade collapses, margin calls, trigger forced selling globally, sharp declines in stocks, crypto, and other risk assets. Understanding these scenarios helps you prepare for both risk and opportunity. Now here's your step-by-step checklist to protect and position your portfolio. 1. Reduce high leverage exposure. If you're heavily invested in leveraged U.S. tech stocks, crypto, or ETFs, take profits and raise cash. The market may move violently and leverage amplifies losses. 2. Diversify across asset classes. Spread your investments across stocks, bonds, crypto, commodities, cash, and precious metals. Diversification protects you from a single shock wiping out your portfolio. 3. Watch the yen as an early warning system. The yen often moves before headlines. A surging yen signals potential rate hikes and risk asset pressure. A weakening yen suggests continued accommodation and short-term market support. 4. Consider Japanese assets. Japanese bonds with rising yields and equities with improving governance may outperform U.S. duration risk. Capital repatriation could create opportunities for savvy investors. 5. Hold precious metals. Gold and silver act as a hedge in both scenarios. Whether the BOJ prints more money or aggressively raises rates, metals protect your wealth against inflation and volatility. 6. Prepare for volatility and plan exits. Expect sharp swings in markets. Plan your entry and exit points, avoid panic selling, and keep some cash ready to take advantage of opportunities. 7. Monitor global signals. Watch JGB yields, Japanese bank reports, and credit spreads. These signals provide early insight into how markets are reacting before the wider world notices. Finally, remember this. February 11th is not just a central bank meeting. It is a potential global financial pivot point. If you position yourself correctly, you can protect your wealth, reduce losses, and even capitalize on opportunities others may miss. Stay calm, stick to your strategy, and focus on signals rather than noise. By following this checklist, you're not just surviving February 11th, you're preparing to thrive in the weeks that follow. Markets will react quickly, and the prepared investor always has the advantage. If you found this series valuable, make sure to subscribe to We Are Cosmic, hit the bell icon, and join the conversation. In future videos, I'll break down how global events impact crypto specifically, step-by-step investment strategies, and the exact moves I'm making before the crowd reacts. Hey everyone, welcome back to We Are Cosmic, your go-to place for crypto insights, finance breakdowns, and understanding how global events affect your money. If you want to know what's really moving markets and how to position yourself before everyone else, you're in the right place. Today, I'm about to take you through what might be the most critical 48 hours in global finance in years. Seriously, this is not hype. What happens over the next 2 days could affect your portfolio for the next 6 months. On February 11th, the Bank of Japan, BOJ, is making a decision that could shake the entire world economy. They are deciding whether to keep printing money or raise interest rates. Sounds simple? It's not. One small decision made by a handful of bureaucrats in Tokyo will trigger a chain reaction that could impact everything from your stocks to your crypto holdings. Japan's economic trap. So, why does Japan matter so much? Japan is the foundation of global easy money for the last 40 years. After the asset bubble burst in 1990, prices fell, wages stayed flat, and economic growth was almost zero. To fight this, the BOJ did things no other central bank would dare. Zero interest rates, negative rates, printing trillions of yen, buying government bonds, corporate bonds, stocks, and ETFs. In effect, they became the largest shareholder in the Japanese stock market. For decades, these measures failed to create lasting growth. But then, in the last 18 months, inflation appeared, not from internal growth, but due to external pressures like rising energy costs, supply chain issues, and a weak yen making imports expensive. Suddenly, Japan saw 3 to 4% inflation, the highest in 40 years. People who spent their adult lives in a world of stable prices are panicking as living costs rise. The BOJ now faces a dilemma: keep printing money and inflation accelerates, or raise rates and risk collapsing the stock market and reigniting deflation. Either way, the decision will ripple across the world. Global connections, U.S. markets, and crypto. Japan owns over $1.2 trillion in U.S. treasuries, the largest foreign holder of U.S. debt. Any change in Japan's policy impacts U.S. borrowing costs. Mortgages, corporate debt, and credit card rates could rise. Stocks may drop as corporate profits and consumer spending decrease. Then there's the yen carry trade. Investors borrow cheap yen, convert to dollars, and invest in higher yielding assets like U.S. stocks, emerging market bonds, or crypto. If the BOJ raises rates, the yen strengthens, borrowed yen becomes more expensive, and forced selling begins. This could trigger sharp drops in stocks, crypto, and risk assets globally. Possible scenarios for February 11th. Scenario 1, BOJ holds rates, yen weakens, carry trade continues, global risk assets rise temporarily, but inflation builds. Scenario 2, small rate hike, 0.25%, yen strengthens, carry trade unwinds, volatility rises, risk assets experience choppy price swings. Scenario 3, aggressive normalization, 0.5% plus, yen surges, carry trade collapses, margin calls hit, and forced liquidations could cause sharp global market declines. Understanding these scenarios helps you prepare for both risk and opportunity. Practical strategies and checklist. Here's how to position yourself. Reduce high leverage exposure. Take profits, raise cash, and lower exposure to highly leveraged positions. Diversify across assets. Spread your investments across stocks, bonds, crypto, commodities, cash, and precious metals. Watch the yen. A surging yen signals potential rate hikes. A weakening yen suggests continued accommodation. Consider Japanese assets. Japanese bonds and equities could benefit if the yen strengthens and companies focus on profits. Hold precious metals. Gold and silver protect against both inflation and market volatility. Prepare for volatility. Plan entry, exit points. Avoid panic selling, and keep cash ready for opportunities. Monitor global signals. JGB yields, Japanese bank reports, and credit spreads give early insight into market reactions. Final advice. February 11th is not just a meeting, it is a potential global financial pivot point. Markets will react quickly, and prepared investors have the advantage. Stick to your strategy, reduce risk, diversify, and watch the signals. By following this approach, you can protect your wealth, reduce losses, and even find opportunities while others panic. If you found this video valuable, make sure to subscribe to We Are Cosmic, hit the bell icon, and join the conversation. In future videos, I'll break down how global events impact crypto, step-by-step investment strategies, and the exact moves I'm making before the crowd reacts. Stay focused, stay informed, and let's navigate these critical 48 hours together.